"Be fearful when others are greedy and greedy when others are fearful" is a quote by Warren Buffett that has probably been very overused over the past few months with all the volatility we've seen over the last few months in the public markets. But this advice has been true for commercial real estate investors, especially during the last recession when opportunistic investors stepped in and acquired properties during the depths of the recession when people were still wondering if real estate would ever recover. So with the immediate future of commercial real estate values uncertain right now, how should we prepare for the future to be able to capitalize on opportunity if that opportunity arises over the next few months? That's what we're going to cover in this video. Hey, this is Justin from breakintocre.com, and if you're new here, on this channel we talk about real estate investing careers and real estate financial and deal analysis. So if you're looking to break into the industry or do your first real estate investment deal, make sure to subscribe and hit the notification bell. So if shutdowns and closures for stores and entire buildings continues for months on end going forward, property revenues and property values are likely to suffer as a result. And if you currently own property during a time like this, you can be met with some significant challenges over the next few months. But if you're an investor looking to do your first deal during a time like this, these times can present some of the best buying opportunities out there, especially if you do these three things we talk about in this video. So during economic downtimes and recessions, how do real estate investors make money? Well, let's start with number one on this list, and that is that they look for the pain. And what I mean by that is that they go where property owners are hurting most, which right now is primarily retail and hospitality. So looking for deals that are well located, well-built assets that are currently having some cash flow issues due to travel restrictions or store closures, or potentially even being over-leveraged, could present a huge opportunity for buyers later on in 2020. So just like investors try to time the market with stocks and other paper assets, by acquiring a struggling property with low occupancy rates and delinquent tenants, but strong commercial real estate fundamentals can present a huge opportunity to commercial real estate investors who are willing to take that risk. Even more recession-resistant product types that are over-leveraged right now, like multifamily for example, might have some major buying opportunities over the next 6 to 12 months if unemployment continues to rise and stays at a high level through the rest of the year. Now obviously this takes risk, and it takes a confident investor to go in, stabilize a property, and be able to capitalize a project fully to make sure that property is leased up and renovated as needed. And speaking of being well capitalized, that leads me to point number two on this list, which is that investors who make money during a recession go into their property acquisitions well capitalized. Now this doesn't necessarily need to be the individual investor and could just start with one equity partner who was able to maintain a strong cash position after all of the economic dust has settled. So this might look like an existing relationship with one or more high net worth individuals, potentially a family office, or even institutional capital partners that know that investor's skill set and have expressed interest in partnering with that individual to buy commercial real estate assets even before the downturn occurred. This is where your relationships that you built before everything went south really matter, and why it's so important to constantly be talking with and networking with other investors to tell them what you're up to or what you're looking to do when the next opportunity arises. Now, I can't emphasize this enough that being well capitalized is one of the most important things to being successful in real estate, especially when you're buying distressed deals. If you're buying properties with high vacancy rates or other cash flow related issues, you may be required to weather the storm for 6 months or more, which takes cash reserves and takes working capital to fund until you're able to stabilize that deal. So for a retail, office, or industrial deal, this might look like putting money aside for future tenant improvements or leasing commissions when you go to lease up a vacant property or vacant suites. Or for a property with deferred maintenance issues, this means raising the capital or having the equity up front to make sure that you can perform those renovations without having to rely on cash flow to fund those capital improvements. Oftentimes, a lease up or a capital project can take much longer than you expected and can be much more costly than you expected. So having the appropriate capital available to make sure that you're able to weather the storm and potentially even pay for things like basic operating expenses is huge when you're going in to buy distressed deals. And investors that are able to do that and go into these deals with an ample amount of cash on hand are going to come out the winners when rents and values ultimately start going up. Now finally, aside from finding the pain and going in well capitalized, many real estate investors that are successful coming out of a downturn are able to lock in long-term fixed rate debt at very low interest rates. Interest rates generally drop as the Fed tries to stimulate the economy during tough times, and today is no different. Now, right now, liquidity is extremely tight in the lending markets because lenders don't know how long this is going to last and are concerned about so much uncertainty in the months ahead. But once things start to stabilize and there are more knowns than unknowns, interest rates will still likely be at or near historic lows, creating great opportunities for borrowers to lock in these rates for 7 to 10 years or more. There are many companies that have even made this part of their value creation strategy over the last decade by locking in 10-year fixed rate loans at low interest rates, assuming that interest rates will rise over time and the next buyer would want to assume that loan and take on that low interest rate. So if you believe rates for comparable loan products are going to jump from 4.5% today to 5.5% 3 years from now, then you might make the assumption that the next buyer who buys the property will want to assume that debt at a 4.5% interest rate with 7 years of term left on it, when the next closest thing they can get out in the market will be 5.5% or higher. Now with this in mind, even though rates are so low, you do want to make sure that you keep your leverage levels somewhat conservative, especially if you're buying a deal with cash flow issues, since you don't want to get caught being over leveraged if your turnaround strategy takes longer than expected. But with that all said, with conservative leverage levels, locking in low interest rates today with long-term fixed rate debt can be a huge boost to your overall returns, especially if you add significant value to the property over time. So together, those are 3 of the most common ways that commercial real estate investors make money during a downturn, and what you might want to focus on today if you're looking to capitalize on opportunity 3 to 6 months down the road from now. Now, if you are going to be analyzing a lot of deals over the next few months, I highly recommend checking out the free Break Into CRE Real Estate Financial Modeling Crash Course. That's going to show you how a real estate financial model works and how you're going to want to add your inputs, your formulas, and your outputs that are going to show you the key return metrics on each deal you analyze. And if you're well capitalized, have the relationships in place, and you're ready to take advantage of the opportunity that might lie ahead and start building your portfolio this year, make sure to check out Break Into CRE Academy. That's going to give you all the technical skill sets you'll need in order to analyze deals and model transactions, and I'll link that in the description as well. So I hope that was helpful. If you like this video and want to see more content like this, let me know by hitting the like button, subscribe to the channel, and share this with anyone else who might find this helpful. Thanks so much for watching, and I'll see you in the next video.